The Fed just shocked the markets and announced what many people were not expecting to hear. Now, we just heard back from the Fed as they gave another interest rate hike, but more important than the interest rate hike is what they had to say about their projections for 2023. Now, the decisions that they are projecting to make in 2023 could cause bigger declines, particularly in the stock market. So lots to talk about today between the Federal Reserve's projections for 2023 and what that ultimately means for the future of the housing market and the markets altogether. But before I get started, do me a favor and support the channel by smashing that like button, and if you haven't already done so, definitely subscribe, hit that notification bell to watch more content like this, and with that said, let's jump into it. The Federal Reserve has officially announced another interest rate hike of 0.5%. Now, this is for the federal funds rate, not to be confused with mortgage rates, as that really pertains to things like HELOCs, personal loans, credit cards, and even auto loans. So if you're looking to get one of those types of loans, or you already have a variable interest type of product like a credit card or a HELOC that you currently have a balance on, you can expect to see that rate go higher in the near future. It also means that you're going to see high yield savings accounts go up as well. So that's at least one positive that comes with this. But with that said, the 0.5% rate hike was really expected. I've been calling it for a while now on the channel that that's what I've been expecting to take place in December. Many experts also thought the same thing, that we'd see a 0.5% rate hike. So that wasn't really the shocking news that came today. What was really the shocking news we heard today was about the summary of economic projections. Now, the summary of economic projections is basically a report they release about once a quarter, and it has all the Federal Reserve members project what they expect to see for the future of the federal funds rate, what they expect to see for the future of GDP, for unemployment, for PCE, and many other things like that. It gives you insight into what their current mindset is as far as what they expect to happen for the future, whether they plan on raising rates in the future, whether they plan on lowering interest rates, or whether they plan on maybe pausing or slowly cutting back. Either way, it gives you insight into what they're planning to do. Now, it was very interesting what we saw in some of these projections. Some of them were completely different than what many experts were expecting to see. So starting with the Fed funds rate, we can see here that for the year 2023, okay, and we're looking at the federal funds rate projections here, September for 2023, they were expecting it to go up to 4.6%. Well, they revised that upward, which was very surprising because, again, inflation data has been coming back much better than expected. We've had two reports in a row that have come back much better than expected. The October report came back much better at 7.7% inflation. Then it dropped down again in September to 7.1%, and really the big number was the month-over-month number, only 0.1% increase. And so it's very surprising. We were expecting that with inflation data coming back much better than expected, that we'd see the Federal Reserve probably take a step back and be a little less hawkish than they're showing in this report. Well, that's definitely not going to be the case, as we see their projections jump from 4.6% up to 5.1%, which what that basically means is they're anticipating there's more rate hikes ahead. We're currently sitting at 4.25 to 4.5% range with the federal funds rate. So if they're anticipating 5.1%, we may be looking at another 1% in rate hikes to go. Now, I want to take you over to what is known as the dot plot. Now, the dot plot is basically where every member of the Federal Reserve plots their own dot to represent what they believe the projection is, and so you can kind of see where every single person stands here. So you can see that most people are sitting at between 5% and 5.25% here, and you can see that some people are actually thinking we may see between 5.25% and 5.5%, and some are even anticipating we go from 5.5% to 5.75%, which is extremely high, again considering the inflation reports we've seen. So overall, many people are anticipating at least a 5%. Here you see 4.75 to 5%. So at least a 5% federal funds rate is basically the minimum expectation, which again is much higher than expected. Now, taking a look at some of the other numbers, we see with GDP, they've revised this downward. It was expected to be 1.2% GDP. That's our gross domestic product, basically represents the amount of goods and services sold around the United States. That's gone down from 1.2% growth down to 0.5% 0.5% growth, which gets us closer and closer to what would be considered an economic recession. So I think because they expect the federal funds rate to go higher, they're expecting that to obviously hit the economy harder, and that's obviously why we're seeing things like the stock market's going down right now. And so it has the opposite effect than we've been seeing lately with these inflation reports having the opposite effect, stock markets rallying, treasury bond yields falling, and ultimately that's caused mortgage rates to fall, which I'll explain in a little bit how this could affect the housing market. We also saw the unemployment rate. Again, of course, as less goods and services are sold, that's going to hurt companies' bottom lines, which in turn will result in more layoffs. And so that's why we're seeing the unemployment projections also going up from 4.4% in 2023 up to 4.6%, and they expect that to stay in 2024. Also, we can see the PCE numbers, that's your personal consumption expenditures, basically measures the amount of consumer spending across the country. The Fed particularly likes to look at core PCE inflation, and they've revised these estimates from 3.1% for core PCE up to 3.5%. Now, the most important metric out of this is really the federal funds rate that gives you more insight into what to expect with the future, especially into 2023. And you can see even the range for the federal funds rate, it was between 3.9 and 4.9. Now it's kind of tightened up a little bit. They're all more aligned with what they want to see, 4.9% to 5.6%. Again, much higher than expected. So what does this mean ultimately for the health of the economy, the stock market, and the housing market? Well, what I think we're going to see, and we're already seeing early signs of it, is obviously company revenues are going to go down as a result of less spending taking place throughout the economy due to these higher interest rates. Well, we just got the latest core retail sales report for the month of November, which came back a lot worse than expected. You see, for the month of October, when we got that back last month, we were seeing month-over-month growth in retail sales of 1.2%. That's gone down significantly. They were expecting it to come back at 0.2%, slowing down drastically from the month before, but instead we actually saw negative month-on-month growth of negative 0.2%. So what we're seeing is these rate hikes that have already happened so far are already having an effect on the overall health of the economy, and we're already seeing these revenues go down. But by hiking interest rates even more throughout 2023, it's only going to put more downward pressure on consumer spending, which is why we're seeing the stock market react so violently right now, because we're already seeing this take place as of right now with the current retail sales. So you can only imagine what that's going to mean for 2023. Now, on the housing front, it's going to be a little bit different with housing, because what we're really looking at to see how much more we're going to see prices decline in the housing market really comes down to mortgage rates. If mortgage rates go back up again, then we will see more significant price declines throughout the housing market. But what's happening is we're seeing mortgage rates go down. The more we get positive inflation reports back, the more we're seeing that consumer spending is going down. All of these are resulting in mortgage rates going down, and they've gone down even more since the Federal Reserve released their projections for 2023. So if you thought that that was going to cause mortgage rates to go higher, you might want to think again. We don't know exactly what's going to happen, but we've already seen them drop from about 6.3%. Now they're sitting at about 6.13%. And if they only get more and more affordable, it is really going to minimize the downside we see with price declines across the real estate market. So I do believe we have more price declines on the way for the real estate market. We're already down 9% from peak levels on a nationwide basis. I think we go further down just simply on the basis that we still have to catch up to the data reflected when mortgage rates were back in the 7% levels about a couple months ago. But in addition to that, I've talked about this on the channel a lot, is we have the builders, the iBuyers, and the investors, the four sellers within this housing market, and that is also going to create the new comparables to again bring house prices down. So we do have more to go, but at the same time, we don't know how far the downside really looks. So with that said, I'm going to continue to keep you guys up to date with what's going on in the housing market, with what's going on in the markets and the Federal Reserve and all that fun stuff. But with that said, if you enjoyed today's video and you gained some value, do me a favor and support the channel by smashing that like button. If you haven't already done so, definitely subscribe, hit that notification bell to watch more content like this. Also, let me know your thoughts or questions in the comments below, and I'll do my best to get back to you. Finally, follow me on Instagram and TikTok at The Out-of-State Investor. And if you enjoyed today's video, I'm going to highly recommend checking out one of these two videos over here. And with that said, I'll see you guys on the next one.